Who gets paid when you swipe a credit card? Every time you tap a credit card, it feels simple. You buy something. You leave. But behind that one tap, a tiny money system wakes up. Messages move, approvals happen, and fees get split across multiple businesses. So today we're answering one clear question. Who gets paid when you swipe a credit card? And we'll do it just how the system works, step by step. Let's start with something important. When you swipe a card, the store does not receive the full amount. The store receives the sale amount minus the cost of accepting the card. That cost is why the credit card system makes money. Now, to understand this, we only need a few characters. First is you, the cardholder. You're making the purchase. Second is the merchant, the store you're paying. Third is your bank, the bank that issued your credit card. Fourth is the network, the rails that connect banks and merchants. Think Visa or MasterCard. And there's one more quiet player most people don't notice, the merchant's payment partner. This could be the acquiring bank, or the payment processor, or a provider that bundles both. This is the system the store uses to accept card payments and get paid. So the cast is simple. Cardholder, merchant, issuer, network, acquirer, or processor. Now let's watch what actually happens in one swipe. You tap your card. The terminal sends a message to the merchant's processor. That processor sends the request into the card network. The network routes it to your issuing bank. Your issuing bank checks a few things. Is the card valid? Is there enough credit available? Does the purchase look normal? Does it trigger any fraud signals? If everything looks fine, your bank sends back one word: approved. And in that moment, the store is confident. They hand you the product because your bank has promised, yes, we will pay. That approval is called authorization. It happens fast. But the money moving is a little different. The transaction still has to clear and settle. Clearing is like matching the details. Who paid, how much, and where. Settlement is the actual movement of funds. Many merchants settle in batches, so the money may hit the merchant's account later, not instantly. That's the first big idea. The swipe is a fast promise. The settlement is the follow-through. Now here's the second big idea. The system takes a cut. The store pays a cost for accepting the card. That cost gets split. And this is the heart of the business model. The merchant pays a fee that is often described as the merchant discount. You can think of it as the price the merchant pays to accept card payments. Inside that merchant discount, the money is divided into three main buckets. 1. Interchange. 2. Network fees. 3. Processor or acquirer fees. Let's unpack those in plain language. Interchange is the biggest piece in most cases. Interchange is essentially a transfer fee between banks. Your bank, the issuer, gets paid because your bank is taking credit risk and fraud risk, and because your bank is fronting the money to the merchant system. In many descriptions, interchange flows from the merchant side through the acquirer to the issuer, and the issuer earns it as part of the economics of the card. The network also earns fees because the network runs the rails. The network is the system that routes transactions, enforces standards, and keeps acceptance consistent. Then the processor or acquirer earns a fee because the merchant needs tools and services to accept cards. Terminals, software, reporting dashboards, fraud screening, dispute support, and settlement. So one swipe creates a fee stack, and each layer is a different business getting paid. Now here's where the story gets interesting. Why would a merchant accept this at all? Because cards increase sales. Cards reduce friction at checkout. Cards let customers spend even when they don't have cash. Cards make online shopping possible. Cards reduce some cash handling costs. And for many businesses, not accepting cards would mean losing customers. So merchants decide this is worth it. Now let's slow down and zoom into interchange, because interchange explains a lot. Interchange is closely linked to why rewards exist. It's linked to why some cards are more expensive for merchants to accept, and it's linked to how issuers can fund benefits. Interchange rates vary. They vary by card type. They vary by transaction type. They vary by risk profile. A basic card might have one structure. A rewards card can have another structure. Online transactions can be priced differently than in-person taps. You don't need to memorize rates. Just remember the logic. Higher perceived risk or higher benefit often comes with higher cost, and those costs are structured so the ecosystem can function. Now, what does the issuing bank do with interchange? It helps fund card operations, fraud prevention, customer support, card production, credit underwriting, rewards programs, and profit. That's why credit card issuers can offer points, miles, and cash back, because part of the system is funded on the merchant side. Now let's move to the network. What is Visa or MasterCard really selling? They are selling connectivity. They are selling reliability. They are selling a global set of rules and standards. They are the traffic controllers for payments. They make sure that a merchant system can talk to an issuing bank safely and consistently. And for that, networks charge fees to participants. If the issuer is the bank behind your card and the acquirer is the bank behind the merchant, the network connects them, so the network earns money because it runs the rails. Now the processor or acquirer, this is the merchant's payment partner. And this role has grown a lot in the modern world, because merchants don't want to build a payments department from scratch. They want an easy system. They want a device. They want a dashboard. They want reporting. They want fraud tools. They want support. They want funds deposited reliably. So processors package all of that and charge a markup. That markup is often the least understood piece, because merchants see one bundled cost. But inside it, there are different splits. Now let's shift to the other side of the business model, because credit cards don't only make money from merchants. They can also make money from cardholders. There are two main categories: interest and fees. If a cardholder carries a balance, interest can become a major revenue stream for issuers. That's part of why credit cards can be very profitable. Some cardholders pay no interest because they pay the statement balance in full. Other cardholders revolve balances, and issuers price that risk through interest rates. Then there are fees. Fees can include things like late fees, foreign transaction fees, balance transfer fees, or annual fees. Not every card has all of these. Some have none, some have a few. But the point is simple. The credit card business model is two-sided. Merchant-side revenue supports the payment network and the issuer economics. Cardholder-side revenue, like interest and fees, can also support issuer economics. Now let's put this into a simple story. Imagine you buy something for $100. You tap your card. Approval happens. Later, the merchant receives something like $100 minus processing costs. Inside those processing costs, interchange goes toward the issuer. Network fees go toward the network, and processor fees go toward the merchant's payment partner. So the merchant is paying for access to a system that helps them sell, and the system's businesses are earning money for making that sale possible. Now, if you've ever wondered why rewards exist, here's the calm explanation. Rewards are not magic. Rewards are a business strategy. Rewards encourage more spending. Rewards increase customer loyalty. Rewards make people choose one card over another, and if spending volume increases, merchant-side revenue can increase. So the system can fund rewards and still remain profitable. That's also why some rewards cards are more expensive for merchants, because the economics are designed to cover benefits and costs. Now, let's go even deeper for a moment. Why is this system built the way it is? Because payments have to solve hard problems: fraud, identity, disputes, security, cross-border acceptance, timing, settlement risk. When you pay with cash, the transaction is final, but cash doesn't scale well online. With cards, we get convenience and protection, but we also get complexity, and that complexity has costs. If a customer disputes a charge, the system needs a process. If a card is stolen, the system needs fraud controls. If a merchant is risky, the system needs rules. If a purchase happens across countries, the system needs conversion and compliance. So the credit card system is built like an engine. It's designed for scale. Now let's talk about one more piece. Why merchants still love cards even though they pay fees. It's because of conversion. In many industries, cards increase the chance of a sale. When checkout is smooth, people complete purchases. When payments are flexible, people buy more. Cards can also reduce cash handling risks. Less cash on hand can reduce certain losses, and modern payment systems can reduce bookkeeping friction. So merchants accept the fees as part of the cost of doing business. And that's why this entire ecosystem continues to grow. Now I want to give you a quick mental model you can keep forever. When you swipe a card, think of it like a relay race. The merchant hands the payment request to the processor. The processor hands it to the network. The network hands it to the issuing bank. The issuing bank approves it and promises money. Then settlement happens, and the fees are split. That's it. Now let's recap in one clean summary. Who gets paid when you swipe? The issuing bank earns interchange and may earn interest and fees depending on the cardholder's behavior. The network earns fees for operating the rails. The processor or acquirer earns fees for providing payment services to the merchant. The merchant earns the sale, minus the cost of accepting the card. So your swipe is not one transaction. It's a small ecosystem. It's multiple businesses collaborating in seconds. And the reason it works is because it solves convenience and security at scale. If you enjoyed this detailed documentary breakdown, subscribe to Finance Backstory Decoded. Next, we can break down another system the same way. Debit cards versus credit cards. Buy now, pay later. Or how banks profit from checking accounts. For now, whenever you tap a card, you'll know the hidden story. You're not just paying the store. You're activating a payment engine. And the engine has multiple paychecks. Subscribe to get more of this finance breakdown.